Hi, there's been a lot of talk lately about silver possibly heading into prices that sound almost unreal when you say them out loud. $300 silver, $500 silver. And then, if you stay around the internet long enough, you start hearing people talk about $1,000 silver like it's just the next stop on the bus route. So, in this video, we're going to separate the real pressure building in the silver market from the parts that are getting stretched. And you are going to walk away feeling a lot clearer about what matters, what does not, and what to watch next. Today is Wednesday, April 29th, New York time, and comment what day and date you're watching from, because I always like seeing where everybody is in the world when they find these updates. And if you value this type of calm, straight breakdown, support the channel by subscribing and commenting John A.G. Best. That tells me you want more work like this, and it helps push the video to people who are trying to understand the metals market without all the noise. So, in case you have not heard the latest version of the silver argument, it basically goes like this. Silver has been in deficit for years. Investment demand is waking up. Some people believe the futures market has kept price lower than it should be. China is showing up in a big way. Solar demand is still important, even with thrifting. And now there is this newer idea that tokenized physical silver could become another demand channel over the next decade. That sounds like a lot, and it is. But not every piece carries the same weight. So let's start with the deficit, because that is the foundation. Based on recently published numbers, silver is expected to remain in deficit again this year, meaning total demand is still projected to be higher than total supply. The expected shortfall is not some giant fantasy number, but it is still meaningful because it would keep the market in a multi-year deficit pattern. Now, a deficit does not mean the shelves are empty tomorrow morning. That is where people sometimes lose the plot. A deficit means the market has to pull from existing inventories, recycling, above-ground supply, or someone's previously held metal. In other words, the system keeps working, but it keeps eating into the cushion. Think about it like a family living a little beyond its income. If there is money in savings, nobody panics right away. But if it happens year after year, the question changes. It is no longer, can we cover this month? The question becomes, how long before the cushion becomes too thin? That is the silver question, and here is where the investment side matters. According to the latest publicly available figures, physical silver investment demand is expected to rise this year, even while some industrial categories soften. That tells us something important. The market is not being pulled by one rope. It is being pulled by several ropes at the same time. Industrial demand matters, investment demand matters, and sentiment matters more than most people want to admit. Now, there is a claim going around that if you include every investment flow in the right way, the real deficit is dramatically bigger than the headline number. I understand the logic. If physically backed investment products absorb metal, then that metal is not casually available to the rest of the market. That is real pressure. But we also have to be careful. You cannot just add every flow together and pretend all of it behaves like coins leaving a local shop. Some silver products are physical, some are claims. Some flows reverse, some metal stays in vaults. Some demand is sticky, and some is hot money that leaves as fast as it came in. So the strongest version of the argument is not that every bullish calculation is automatically correct. The strongest version is that official headline balances may not fully capture how tight the available market can feel when investors, industrial users, and vault demand all show up together. That is a much better argument, and it is harder to dismiss. Now let's talk about the big price claims. You will hear people say silver should already be somewhere in the hundreds if the modern paper market had never existed. Maybe you have heard numbers in the mid-hundreds, maybe higher. The idea is that futures trading, leverage, and paper claims distorted true price discovery. Could paper trading affect price? Yes. Could large short positions or leverage structures create strange behavior? Absolutely. But can anybody prove the exact price silver would have today in a world where those markets never existed? No. That is an estimate. It can be interesting, it can be useful, but it is not a fact carved into stone. And this is important because we do not need a perfect alternate universe price to understand the real issue. The real issue is whether there are more people holding financial exposure to silver than people who could actually take delivery if confidence changed all at once. That is the part that matters. Markets can run on confidence for a long time. They can look stable. They can look boring. They can look controlled. And then one day, the question changes from, what is the quote on the screen, to where is the metal? That is when silver can get very interesting. Now, before we get carried away, we also have to look at the bearish side, because ignoring it is how people get trapped. Higher silver prices create a response. Recycling improves, jewelry demand can fall. Silverware demand can get hit. Solar manufacturers try to use less silver per cell. They start redesigning, thrifting, substituting, and squeezing every fraction of cost out of production. And recent market updates show exactly that. Industrial silver use is expected to soften this year, partly because the solar industry has been reducing the amount of silver needed in each unit. That does not kill the bull case. But it does mean the bull case has to be smarter than just saying solar goes up, silver goes up. The better argument is this: even after thrifting, even after substitution, even after some demand destruction, silver can still stay tight because mine supply does not respond quickly. That is the part a lot of people miss. A large share of silver comes as a byproduct from mining other metals. So even if silver doubles, triples, or does something wild, the world cannot instantly turn on a giant silver faucet. You need copper, lead, zinc, and gold projects. You need permits. You need refining. You need capital. You need years. That makes silver supply stubborn. And when demand is flexible but supply is slow, price becomes the pressure valve. Now let's bring China into this. Chinese gold buying has been one of the clearest signals in the precious metals world recently. While Western investors were pulling money from gold funds during a rough stretch, Chinese investors were adding at record levels. That is not a small difference in attitude. That is two completely different readings of the same global environment. And why does that matter for silver? Because Chinese households are dealing with a different set of choices. Property has not felt like the easy wealth engine it once was. Deposit rates are not exciting. Domestic stocks have not exactly inspired universal confidence. So hard assets start looking more attractive. If even a small slice of savings shifts toward precious metals, it can matter. Now, I'm not saying every Chinese saver is suddenly buying silver bars. That would be silly. But in a country with massive savings, even a modest reallocation can create visible pressure in metals markets. Gold sees it first. Silver often follows later, and usually with more volatility. That is why the gold ETF story matters. In March, physically backed gold funds saw a huge Western outflow, led by North America, while Asian demand helped keep the broader quarter positive. Then Chinese gold funds saw their strongest quarter ever, with holdings and assets reaching new highs. That tells you the metals market is not one single crowd. It is regional, it is psychological, and it is political. Western investors often ask, will the central bank cut rates? Chinese investors may be asking, where can I store purchasing power while everything else feels uncertain? Those are different questions, and they create different behavior. Now let's deal with real rates. A lot of people think gold only goes up when interest rates are cut. That is too simple. Gold cares about the return you get after inflation. If inflation stays sticky while rates do not fully compensate you, the real return on cash can feel weak. That is the environment where gold starts looking better, even if official rates are not falling fast. Silver feeds off that same psychology, but with an extra industrial twist. So you can have gold rising because people distrust money, and silver rising because people distrust money while industries still need physical material. That combination can get explosive. But again, timing is the hard part. Now let's talk tokenized silver. This is the sleeper idea. A token backed by real metal in a vault. Not imaginary silver, not a meme coin, not a promise with no audit. The serious version is one digital claim tied to real physical metal, stored, verified, and redeemable under clear rules. Gold already has large tokenized products, and recent reports show that one major stablecoin issuer has accumulated a very large gold position through its gold strategy. That is important because it proves digital asset demand can cross into the physical metals world. Could silver be next? I think it can. But here is the catch. Tokenization only matters if people trust the custodian, the audit, and the redemption process. Without that, it is just counterparty risk wearing a shiny jacket. So I would not build the whole silver thesis on tokenization. But as a third demand wave, after industrial demand and traditional investment demand, it deserves attention. And 5 years from now, people may look back and say, wait a minute, that was one of the early signs. If you're successful, share your success story in the comments so others can stay motivated. Now we have to zoom out to the economy, because this is the part that could make all these price targets seem less crazy over time. The official financial stability conversation has become much more serious. Recent global stability reports have warned about elevated financial risks, the war in the Middle East, high debt levels, rollover pressure in major bond markets, and the possibility that stress can spread through leveraged non-bank players. That is not the same as saying collapse tomorrow. And this is where I want to be very clear. Some people hear an institutional warning and immediately turn it into, the system is ending next week. That is not what we should do. The real warning is more subtle and honestly more useful. The system is more fragile when debt is high. Refinancing needs are large. Energy prices can shock inflation, and leveraged players may be forced to sell into volatility. That is the setup, and this brings us to fiscal dominance. Fiscal dominance sounds complicated, but it is very simple. It is what happens when governments borrow so much that policy starts serving the debt. The central bank may want to fight inflation. The government may want cheaper financing. Voters may want support. Markets may want discipline. Everybody wants something. But the math does not care. The math just sits there. And if interest costs keep rising, governments eventually face ugly choices. Cut spending, raise taxes, inflate the burden away, or pressure the financial system to absorb more debt at rates that are politically survivable. None of those choices are painless. That is why precious metals matter. Not because they solve every problem. They do not. But because they sit outside someone else's promise. Now, does that mean you should want the financial system to break? No. Please do not root for that. A broken system means frozen credit, emergency rules, job losses, political panic, and price discovery that gets ugly very fast. What you want is repricing without breakdown. You want silver and gold to reflect reality while markets still function. That is the sweet spot. So where does this leave $300 silver? I would not treat it like a guaranteed appointment. It is not something you circle on a calendar and wait for. Silver can disappoint people for a long time. It can shake out impatient buyers. It can surge, pull back, and make everyone doubt the thesis right before the next move. But I also would not laugh at the entire idea anymore, because the ingredients are real. Multi-year deficits, stronger investment interest, slow supply response, Chinese hard asset demand, Western policy uncertainty, tokenization experiments, sticky inflation risk, fiscal pressure, and a gold market that keeps telling us paper confidence is not as strong as it used to be. The mistake is thinking one catalyst has to do all the work. It does not. Silver does not need only solar. It does not need only China. It does not need only ETFs. It does not need only tokenization. It does not need only inflation. The real risk for the shorts, and the real opportunity for patient holders, is when several of those forces hit the same narrow market at the same time. That is when price can move in a way that feels impossible until after it happens. So watch the flows. Watch the physical market. Watch gold. Watch real rates. Watch China. Watch whether industrial thrifting is enough to offset demand. Watch whether investment demand keeps absorbing supply. And watch how policymakers behave when the next stress event appears. Because their reaction will tell you more than their speeches. If they choose liquidity over discipline, metals will hear it. If they choose discipline, markets will feel pain first. Either way, silver is becoming harder to ignore. And that is the main point. That is how you stay patient without falling for panic or ignoring the real signal underneath the market noise. Not panic, not fantasy, a setup. A setup with risks, flaws, timing problems, and real upside if the pressure keeps building. So stay calm, think clearly. Do not let wild targets make you reckless. And do not let short-term pullbacks make you forget the bigger structure. This video is for education and perspective only. I am not your financial advisor, I do not know your personal situation, and nothing here is a command to buy or sell anything. Do your own research, check the numbers yourself, and make decisions you can live with, even if silver takes the long road first.